听见资本本期视频为您带来的是摩根大通在4月4日录制的内容，话题关于特朗普政府的关税政策升级，正在历史中留下印记，并对全球经济结构产生长期影响。分析师刚刚拉响了警报，他们正式预测美国即将陷入衰退，而且可能拖累全球经济。是什么让他们做出如此重大的转变？是史无前例的关税上调，他们直言不讳地称之为2战以来最大规模的增税之一，将直接冲击企业和普通家庭。但风险远不止于此，他们警告说，这标志着一种根本性的信心破裂，企业可能不再相信当前的政策环境是友好的，就算政策有所回调，造成的损害还能挽回吗？你将听到他们深入剖析这场巨大冲击可能如何演变，消费者何时会真正感受到通胀的压力，企业将如何收缩。更关键的是，美联储将如何应对这个两难困境，一边是不断上涨的物价，另一边是迫在眉睫的经济衰退风险。此外，还有一个令人担忧的深层问题，这些政策是否正在对经济的长期增长潜力造成持久的结构性的损害？这是一份你绝对需要听的关键分析。接下来是英文录音的全部内容，如果您需要我的投研助理人工校对的中文文本，您可以在频道的 Patreon 上获取。
Welcome to the JP Morgan Weekender. I'm Bruce Kasman, and with me this week is Joe Lupton. Hey, Joe.
Hey, Bruce. I think the only good news this week is that you and I are finally back in the same rooms together. I can see you over there now.
Hey, I guess what I'm feeling right now is an enormous sense of tiredness. It's been a very long week. Yeah. So if I can't carry this, I'll let you do more. But I'm trying to figure out how we want to start today. I mean, there's so much going on. I think we probably have to start from where we are on our macro views, which is as we've been kind of worrying and dithering about this tension between resilience and policy drags, tilting over into something worse like a recession for some time now. I think this week we went over the top and we've basically put in a US/global recession in our forecast. The issue, I think, which is interesting is we did so even though the data this week, I think, was reasonably constructive in terms of giving us a sense of a economy that's still solidly on expansion. So I think the interesting question here is how are we kind of reading the interaction between these drags and where the economy stands, and what do we kind of think is the path from here to something which we now think will break. Maybe take the start on this, maybe just talk about why we think there is going to be a recession here, what has changed that, brought us over that edge in terms of this week's news on tariffs. And then we can kind of go from there to talking about a bunch of other stuff that kind of keys off of that.
I think what you said up front is actually quite interesting, right? This notion
that I'm tired.
That's actually not surprising at all, Bruce. It's nap time for you. The idea that we're doing this in a week where actually the data flow has been good, right? And we've been talking about this kind of framework of worlds colliding, that you've got a healthy, resilient global expansion. And normally momentum's your friend and you just kind of extrapolate that. But when you get hit by these shocks and we are colliding with another world, you need to move very, very quickly. And I think that is what we've been doing. So, it's important to recognize the health of the U.S. payroll numbers. It's important to recognize the PMI numbers, the global PMI numbers that we had out this week. All of that gives you a sense of the resilience that can potentially absorb some of these shocks, but scaling that momentum to the magnitude of the shock is what we're paid to do. And I think we're seeing now that the shock is big enough that recession is coming. And the shock that we got this week was a big one, right? I think you and I and the team in general have been probably on the more concerned side of tariffs than consensus. We had a sense that tariffs were maybe going to get up to something like originally like 8%, then 11%. I think I had been asking you over the course of the past number of weeks, what level would get you to the point where we'd contemplate recession. I think it was somewhere around 10. And lo and behold, we come in this week and we just skyrocket to roughly 24%. I mean, let me just put that into context, which I think you asked. Like, to go from 2.5% at the start of the year to 24% off a base of roughly $3.25 trillion imports, that's about a $700 billion tax hike. And please, everyone listening, and if you've been listening to me over the past, several weeks and months, this is a tax hike, not a tariff, or that those two are synonymous. This is a $700 billion tax hike.
Tariffs are tax hikes on U.S. businesses and households.
Exactly. Where it falls is an open question, but I think most of it will be on households. Some of it will be absorbed in margins. But it's about 2.4% of GDP of a tax hike. That's on par with the biggest tax hike we've seen in the post-World War II period. So it's a big deal. It's a really big deal. And if this is sustained, I think there is we would be highly confident that a recession would be coming. The question mark that I have in mind, and maybe we can kind of open it up at this point or come back to you, is does this get worked off? Is there going to be negotiation?
I think you're going too fast here. I don't want to make that leap without going a little bit more into it, because I think the reason why I'm pretty much there in terms of recession is not just because of the size of the tax cut. I think a tax hike. I think there's other things that are interacting with it, and I'd emphasize two or three things here. The first is one we've been focusing on, is the idea that alongside the direct effects of a higher tax rate on U.S. businesses and households, you're creating a reassessment of what the business sector particularly, but businesses and households generally, are thinking this administration is about. I think we've made a very powerful transition in less than 3 months from a view that this is an administration that may have its wild ideas and want to move in extreme ways in some places, but that would be constrained and balanced to make sure that it supported the expansion and supported the business sector. I think that's we really changed, or at least I really changed, when we put the tariffs on Mexico and Canada in early March, even though they lasted for a day. But yesterday, if you had any, and there was debate, as you know, we were debating with clients at the beginning of the week what we would get on Wednesday. But I think if there were any doubt that this has been broken, this idea that this is a business-friendly administration, and that's broken. And with that break, we're going to see business sentiment make a much bigger drop in the next couple of months than we've seen so far. So that's point one.
You're right, Bruce. And I think you add to it the fact that, the other areas of policy that were supposed to be potential offsets just aren't coming. I mean, the debate over the fiscal tax and spend, people are kind of finally starting to realize that at best you get an extension of TCJA, which is neutral, and you're probably going to pay for it with tax or spending cuts, which is more austerity. The DOGE efforts, I think, are a bit of a fiasco, really, in terms of doing institutional damage and the kind of chaos that is creating in the structure of DC and really the pipeline of government services to the rest of the country. That is a big shock as well. And all of this, I think, is coming together. Notably, as you just said, it will start to weigh on sentiment much more aggressively, and that is a key channel transmission.
Now, there's more here, and I think if I had to say what was the biggest surprise to me this week about the announcement, the size was clearly a big, but related to that, very closely related, was the design. And what we have here is a design which is basically saying, rather than put tariffs on in a tactical way that has to do with where we see the most serious problems in terms of unfair trade practices, even going into areas we wouldn't think are unfair trade practices like VATs and the other. What we have is basically an approach that says we're going to look at who's got a bilateral deficit with us, and we're going to take that deficit and put a tariff rate on it that we think is going to normalize trade over a short period of time. The idea that we're supposed to be trying to move towards balanced trade with everywhere else, that will maximize disruptive effects of tariffs in the sense that what you're ending up,
yes,
in the sense that what you're doing is that you're putting the biggest weight of tariffs on the places where U.S. businesses and households value the imports the most. And you're then also creating, because you're creating a differential rates, which are very large across countries, you're creating incentives or big inefficiencies in terms of, well, if Vietnam tariffs are 45% and, tariff somewhere close by, Singapore somewhere is lower, well, we're just going to redirect traffic through these places. You're just creating a huge amount of
gaming. Now, obviously, then their imports will go up and you can chase this around, but it's supposed to be reciprocal tariffs. That's the way it's billed at, but they didn't even use tariff information to design the system. There's nowhere in that formula that tariffs are in.
No, it's not a reciprocal tariff. It's a tariff that's designed to close bilateral tariffs on it. And I forgot who said it. I think it was Blanchard who said it, which I think was good. It's like living in a village where you're the grocer and you got a baker and you got a plumber and you got all these things, and saying, okay, not only do I want to say, hey, I don't want to spend more than I earn, but I want to have a balanced income and spending pattern with my baker, my grocer, my banker, and all of these people.
To put it more cleanly, I run a trade deficit with my grocer every day of the week, right?
Yeah,
so
exactly.
do I want to kind of remove that? It's a fundamental misunderstanding of not only what trade is, but how economies work, and frankly, what capitalism is.
Yep. No, I don't want to egg you on any further here, Joe. But let me take.
But I mean, back. Let me just say,
let's take it back a step.
Yeah, this is a big shock, right? That's where this leaves us.
It's a big shock, and it has multiple dimensions, including the tax hike, including the sentiment shock, including the disruptions. And one thing we haven't just said, which matters, is that there's almost certainly going to be a fair amount of retaliation that's going to kick in here in the next number of weeks. So all of that is in the mix. We've already seen it from China this morning.
In fact, I want to just kind of make a little point on this. You've seen this kind of what China did, which was 34%, and you kind of see it billed as this tit for tat. That caught my interest because, there were studies on game theory that goes back to the Cold War, where people looked like, what's the optimal strategy to respond in a repeated prisoner dilemma type game? And the optimal strategy turns out to be tit for tat. That's where the whole proportionate response you see in geopolitical relations always comes up. It comes from these results talking about the optimality of tit for tat. Well, I think our trading partners are understanding that now, and I think you're going to see a lot more tit for tat trading type strategies.
So let's leave this on the table. And then what I want to get into one more thing before we jump to the can this be reversed and also policy responses, which is, I do think it is going to be a pretty important test here, both in terms of how the timing as well as the ultimate magnitude of this shock gets felt in terms of consumer behavior in the next couple of months. And I think we have an interesting dynamic because I think you can already start to see it, that the consumer in March is going to surge here, reversing a good portion of the drops that you saw in Feb. Just like that, I think, was an unwind of some strength in the fourth quarter and probably some weather. This is going to be viewed in part as front loading, which I think it is. But we're going to be sitting here for a while waiting for the main event, which is the interaction of consumers being squeezed by higher inflation, businesses being hit by sentiment and higher costs for their exports to really back off. And I think the issue around how willing are consumers to smooth, how long does it take before these shocks build enough damage to really potentially throw the economy off is I think it's a pretty difficult question to get your hands around at this moment. But I do think we're not going to see it immediately. And certainly I think the next set of news coming through on the consumer is actually going to be surprisingly good.
Yeah, yeah. I mean, this kind of comes back to the whole world's colliding point that there's a lot of kind of good, strong momentum, and you've been flagging this kind of March bounce back point. I had been kind of concerned at the start of the year that, hey, maybe we don't even have that much resilience. Things do look like they're bouncing back in the March numbers. And I think that's also, by the way, the thing that is keeping the Fed somewhat cautious here, which I assume at some point we're going to say a little bit about. But
yeah, we're going to go there in a minute. But yeah, you want to finish your point here?
Yeah, that resilience in the global expansion is what maybe makes you feel like this can continue a little bit longer. And it's important for when you think things start to break as well, right? The timing of this recession is important. In fact, I think you're having it, I'm having it a lot with clients about just tracking when does something start to break here. It's tempting when you see a shock like this to think, oh, next week's claims are going to spike to, 320 or whatever. But it's possible you get a bad April payroll report. There's some technicalities in that, but this may linger. It may take until August or September until you start to see things really roll over. If this becomes more of a snowballing sentiment style type shock.
So let me go to what I know you wanted to get into, which is there a opportunity to put Humpty Dumpty back on the wall here?
Yeah. I mean, I've been one of the more kind of negative, have one more negative views on where we're going here since the election. But I will say I feel like there is a temptation to jump all the way to 100% recession. I don't know. I mean, this administration is, in particularly Trump, is kind of so back and forth. You saw some comments about maybe a deal with Vietnam. It would not be.
That's not going to change much.
No, of course not. But it's indicative of is this the beginning of a lot of these types of deals? And is the administration starting to freak out a bit of the market? This is where I started all this notion of the kind of Trump put. Is it somewhere in there, and is it going to show itself by way of a lot of kind of so-called deal making and face-saving deals that dial this back? I think the point here, and you and I were debating this a lot earlier this morning, and I think you raised a good point, which is what's the delta on that? I mean, if the delta is 10 percentage points, which would be a lot of deal making, you're still only going down to something like somewhere between 10 and 15, which would have already pushed us over the edge into recession.
And that also speaks to the broader issue of sentiment, which is, I think, if you kind of step back partially here, you still have done the damage to sentiment. You're not gonna be able to put that back in the bag. So, I mean, it's certainly possible. There are other things on the agenda of the administration which are more growth supportive, but I think it's hard for me to kind of see the scenario where you roll this back in a way that we're sitting here in 2 weeks and we feel like we've want to take our recession call back. Well, I think I still think, and maybe I'm a little less on the the story as you. I still think there is a chance resiliency can hold, but I'm not by any means pushing that as anything close to a baseline. I think there still is a test here of resiliency against the shocks, but I think the shocks have gone large enough here that it's hard to see how you'll see resiliency past that test.
Yeah,
but I do want to give it the test. It has an opportunity here, so let's see how that goes. But let's go to policy. One thing you could say here, which is I think important, is that nobody really but the U.S. at this point is facing the same kind of tax hike. So there isn't the kind of inflation constraint on central banks outside the U.S. There is some pressure in some cases. So I guess before we get to the Fed, how much policy easing might we get outside the U.S. in the next 6 months that's beyond what we've already built into our forecast?
So I think if we're going to contemplate a U.S. recession, then the next question we need to ask, is this going to be a global recession, which is a a unique conversation to have because I think usually we would talk about a U.S. recession being a global event. This is a bit different because the shock is homegrown in the U.S. and feels very kind of domestically focused. And as a result, I think you could start to tell a story where the rest of the world kind of muddles through. I wouldn't put a high probability on that. Probably, I would say, maybe a global recession is probably twice as likely as this muddle through scenario. If you get a global recession, then everyone's cutting aggressively. I don't have the numbers. I know the U.S. number offhand is about 350 basis points usually. And there's no usual recession, but on average. I would assume you would get big moves elsewhere. I think for places like the ECB, which have already cut significantly, they maybe have less kind of runway, but they would go down aggressively as well. I think the one the scenario that's interesting is this one where the rest of the world is maybe not necessarily going into recession. What do they do?
Well, I would kind of also flip the story a little bit there, which is to say, I think, and we can talk more about the Fed in a minute, I think both the Fed and U.S. fiscal policy is constrained here. But I think there's more flexibility elsewhere to do preemptive things. As I said, you're not getting an inflation shock in the next 2 or 3 months in Western Europe. You're not getting inflation shock in Asia. So even before you recognize whether the U.S. is going down here, you're worried about your industries. There's going to be a hangover from the front loading in the industry data that we've seen in the first part of the year. So my bias, and then there's going to be specific sectoral stories that are going to be under pressure here because of U.S. tariffs. So my bias is to see both fiscal and monetary policy actions that are beyond what we have already forecasted. I'm not
without a doubt. I mean,
so I think people get
flagged. We've already flagged this year from the global team that fiscal is probably going to be easier than what our own bottoms up forecast were saying.
Right, but I'm saying given wherever we were,
yeah,
2 weeks ago, I think we get more, and that does provide some cushion. I don't want to overestimate the size of it. That can help weather the storm in the face of what if it becomes a bit more U.S. centric in the dynamic. And again, you don't have the tax increase waiting to see the retaliations elsewhere. But let's turn now to
just let me say, you had mentioned that you don't have the type of tax increase that would push your inflation story. Obviously, if you get these tit for tats, that will be inflationary. And so central banks have to worry a little bit about that. The one thing that's happening that's quite unique, I mentioned earlier, is that the dollar is moving down. Right? Usually something that would limit some policymakers' response, particularly the further out from the majors you go, is the currency move. There's a sense that maybe this is not happening as much. Again, that idea that the shock is happening in the U.S. and so elsewhere is not feeling the pain as much. But that underscores your point and gives a little bit more support for the idea that policy can be more supportive here.
Well, I would just say all else equal, when you have a shock and capital flows to the U.S. Relative to the rest of the world, whether the shock is a U.S. shock or elsewhere, the U.S. is getting helped by that capital flow, lower interest rates, stronger dollar, and the rest of the world gets somewhat hurt. These are usually second order effects, but they do matter. And your point is right that maybe we're not going to see that channel operate here. But I would say, yes, you will have retaliatory effects, but let's not ignore the fact that the U.S. is putting tariffs up on everybody. Everybody else who's doing retaliatory stuff is putting tariffs up pretty much only on the U.S. So the price shock is totally different in scale in terms of what you're getting. So, but now let's turn to the Fed. Kind of give me your view. I mean, Powell was interesting today, I thought, in not in a terribly surprising way, but his desire to kind of, talk about the need to maintain the anchor here. It was on the hawkish side.
Let me be more specific, if I can turn to our natural language processing model on this. It moved up in a hawkish direction. That would be point one. I think far more telling is This was the most hawkish speech he's given since June of last year, based on our natural language processing model. And that includes press conferences, which tend to always run more hawkish. If you just look at his non-press conference speeches, it's the most hawkish speech he's given since December of 2023.
I thought you were going to say since 2018, which would have been a good parallel, perhaps. But okay.
Yeah, exactly. No. But I mean, the point here is that, I mean, they can't ignore this healthy data. I think, and really it underscores what I would tend to say. Like, I think that the Fed has a predilection prior to this week. The Fed has a predilection to lean hawkish. And this is against an environment where it's got healthy fundamentals and sticky inflation. And that's why it's been leaning hawkish. I don't put a lot of weight on the press conference that Powell gave last meeting as being somewhat dovish. I think that was a little bit weird, and maybe for an audience of one. But I think you look at all the speakers after that, they were generally in the hawkish direction, worried about second order effects, saying they can't view this as transitory, notwithstanding what Trump said. And so that's my starting point. But I do think that as you start to see the shock here, and the Fed's doing the same type of calculation we're doing, the staff is, and they're putting recession risk probably above 50, they're going to want to ease, and they're going to want to look for the first excuse to ease. And when that data break is, I don't know. I mean, maybe you've got a good sense of it. Presumably it could come quickly as, you've seen this point. I think you were the one who raised it to me that, April payrolls could be fairly ugly if you get a lot of these asylum seeker permits that come off, and you got 100,000 of them that are Venezuelans. If those roll over and you get like a 0 or a minus print on April payrolls, May could be your first cut. If you also see the sustained tariffs, if you don't get the backpedaling, it could come as soon as that is when they start moving.
Yeah, I mean, it's possible. You'd have to have really scary payroll number because of the backdrop of what will not just be a solid March payroll report, but I think a solid set of activity data across the March readings. So, you could have financial stress, you could have a quirky, very weak payroll number, and it's certainly possible. But I would, I would say we've probably, and I think the market has taken out some of the probability. I think it's down to about 30% for May. That said, I think the point you're making is exactly right. As soon as the Fed feels like things are giving it enough support to recognize that the risk of a break has gotten high, it eases. I don't care whether inflation is 3%, 4%, or 5%. The question, I think, is, as you say, when did that happen, and what would be the nature of that signal? And I think we can go through it. There are different ways it can come. There's obviously a payroll, trajectory that breaks. There's a spending and on the business and consumer side that could be scary. And then there's a financial story, market story is not about the equity market going down, but it's about the drop in asset prices starting to feed some funding credit market pressures that would get the Fed.
I think it's the credit markets that the Fed always focuses on. People tend to talk about Fed puts in the equity market. I think that's silly. If the equity market goes down a ton, generally that's correlated with a lot of other things that are going wrong. So if you see a correlation, don't confuse that with causation of Fed moving. But credit markets is where the Fed will react to. That will be causation. If they start to see things getting really ugly in funding and broader credit markets, that coupled with kind of some of these data breaking, that would get them to start that cutting cycle.
So I want to make one last point. I'll let you make one last point, and then we'll close out. What do you want to make a point? Anything you
Why don't you go first? I haven't thought about my summing up.
Okay, I'll make my point, and you can then think about what, if anything, I think the quiet but very important part of this conversation is that I don't think what's happening here is only about the business cycle. I think what you're seeing is U.S. policies do things which are damaging in a longer lasting way. And it's not just the trade policies, it's the immigration policies. There's obviously other things going on that could be positive. We could talk about regulatory policy, possibly tax policy. But I think the broad sweep of what I'm seeing makes me worried that we're doing damage that once we look past recession and early recovery might end up telling us we've had a lasting shift in our supply side, in our ability to grow. And that I think is clearly a troubling aspect. And as you said, with the dollar moving down, there may be some of that's beginning to get into financial market pricing as well. So that's my last upbeat observation for the
Well, I was going to say something that actually aligns very much with that. I was going to put it a little bit differently, because I was going to say there is this notion, and we talked a lot about when do we break into recession? What would that look like? What are the risks that we break into recession? There is kind of what comes after that, as we were kind of talking about the trade after the trade, which is, how deep does that recession look? How long does it last? And the kind of the mindset that I have here is, I'm still a believer that kind of this is, I think you and I differ a little bit. It's probably going to spark a longer conversation, which is that
I'm going to keep my mouth shut.
Recessions are about clearing out like significant imbalances. And I think to the extent we don't have significant imbalances, that it would not be, I don't see the mechanism for driving a very deep recession. Now, you can say that maybe we're going to reveal something and, you never know what's going to happen, what's the skeletons in the closet. So I get that. But in general, I just wouldn't think it would be a very deep recession. But to the point about us doing real structural damage, it does suggest that either a recession would linger or any type of recovery would not get us back to where we were, because we are in the process of doing permanent damage to the U.S. economy, and that will have these lingering effects that you're talking about. And this has important implications also for inflation and Fed, because if there is a permanent supply shock, then the Fed is going to have a decision to make. Obviously, all else equal is going to mean higher inflation. But the Fed, as you always say, and I agree, inflation is a policy choice. If they want to accommodate that, they're going to have to keep rates kind of easier than they otherwise would. Or are they going to recognize that there's been a permanent supply shock and therefore remove that accommodation more quickly and not really allow for a strong recovery, to kind of recognize and level set to a world where the U.S. just isn't as strong as it used to be? That dance and that kind of confusion about like the Fed trying to find where the kind of new normal is going to be difficult for the Fed, and it's going to be kind of doubly difficult to do that against a backdrop where you have Trump hanging over you, complaining to you that you should be accommodating this a lot more and maybe letting inflation run a bit more. That starts to sound a lot like the 1970s. I don't think we're going there, but that only then would I start to think about this stagflation type scenario that people are talking about too early right now, I think.
Rather than turn this into an hour conversation, I'm going to say, okay, let's end it here.
I did that knowing that I'd be able to get the last word on this conversation, Bruce. I can see you.
And that's fine. We'll get back to this at some other point.
Yeah.
All right. Take care, everybody. Hope everybody gets some rest, because I'm sure the next week's going to be just as active and interesting as the last one. So hope we can continue the conversation on the Weekender. Take care.